8:45, stock market opens in 45 minutes. Lots of other stock markets are open. What's up, Nikarasu Mosvani, blue chip investor, Josh and Emily, Sad Boy, Calvin, DR, Vincent M, Robin, Nina, Marco. What's up, everyone? Yeah, I think the macro things, I'm going to start doing some more macro content, but I think macro is kind of a waste of time for most people. What are you going to try to do, time the markets? Fate will laugh at you. The gods will laugh. They're trying to time the markets. Let's throw them a curveball. It's not easy. Get a little bit of alpha out of equities. A little easier, I think. Realistic. If you're working on Wall Street, you should not be trading the personal account. I never did that. If you're working at a hedge fund, you trade for the hedge fund. You can't also trade for a personal account. If you're working at a company that does stuff in your sector and your job is to do like research and strategy on other companies, you can trade for your own account, but you have to make sure your company knows about it. Maybe you guys didn't assume that I was an ethical leader, but I do think it's important to be ethical in the workplace. Let's see what's going on. Is it M&A season? There's really no such thing as M&A season. You know, there's a lot of deals do get announced in Q1, but deals get announced all the time. I need some of this stuff, my own personal concoction. Let's see here. Everyone wants to know, how do I maintain my edge? That's how. Visine dry eye relief. I was just about to look at a couple of tech results, speaking of which. McDonald's also helps, yes, it's true. All right, I'm going to look at Google. Vyvanse, Visine. Visine is not bad for your eyes, no. I do have breakfast coming, so. All right.
Standing by for the Alphabet fourth quarter 2022 earnings conference call. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question and answer session. To ask a question during the session, you will need to press star 11 on your telephone. I would now like to hand the conference over to your speaker today, Jim Friedland, Director of Investor Relations. Please go ahead.
Thank you. Good afternoon, everyone.
7% constant currency growth, pretty bad. Let's see, YouTube down year over year. Oof. I had YouTube returning to growth, but it was not in the cards. 2 down year over years in a row for YouTube. That's a recession that's a decent definition of a recession. If YouTube can't increase revenue, then I don't know. I'll look at TGTX, sure. Google search down year over year as well. They weren't down last quarter, but still very concerning. We're definitely seeing a tech slowdown, or economic slowdown, because our economy is more and more defined by technology. Yeah, I thought that we'd have 10% growth. I thought this was a temporary lull. We went from 24%, 14%, 4%. I thought we'd pick back up to 10. We went down to -2. Oof. How about Cloud? Cloud did better than I thought. Cloud did amazing. Am I looking at the right line? No, I'm not looking at the right line. Okay. Phew. Cloud did okay. Cloud did all right. Not good, not great. I wouldn't worry on about the Chinese balloon. This is not going to affect your stock portfolio. And if it does affect your stock portfolio, it'll affect all of them equally. So try to focus on one thing. Focus on doing one thing really, really well. Right? Google Network was also down substantially. Just an awful dog poop quarter for Google. Yeah, so you can see with employee growth of 17 to 22%, without commensurate revenue growth, you have a big issue, right? So they had 120,000 employees. Let's do revenue per employee. Kind of an interesting metric, isn't it? Innit. I love that word, the British innit. I-N-N-I-T, I think. All right, so 334,000 in revenue per employee per quarter. Keep that in mind. And that was going up, which is kind of amazing. So every employee at Google brings in around 1.2 million in revenue. In it, fam. Woke up this morning. Hey, gabagool. What are the UK government's priorities for financial services reform in 2023? Hell if I know. How would I know, buddy? All these random updates. Woke up this morning. There's my food, hold on.
And welcome to Alphabet's fourth quarter 2022 earnings conference call. With us today are Sundar Pichai, Philip Schindler, and Ruth Perret. Now, I'll quickly cover the safe harbor. Some of the statements that we make today regarding our business, operations, and financial performance may be considered forward-looking, and such statements involve a number of risks and uncertainties that could cause actual results to differ materially. For more information, please refer to the risk factors discussed in our Form
Trashy is at home. She's doing well. Thank you for asking.
10-K and 10-Q filed with the SEC, including our upcoming Form 10-K filing for the year ended December 31st, 2022. During this call, we will present both GAAP and non-GAAP financial measures. A reconciliation of non-GAAP to GAAP measures is included in today's earnings press release, which is distributed and available to the public through our investor relations website located at abc.xyz/investor. Our comments will be on year-over-year comparisons unless we state otherwise. And now, I'll turn the call over to Sundar.
Thank you, Jim, and good afternoon, everyone. It's clear that after a period of significant acceleration in digital spending during the pandemic, the macroeconomic climate has become more challenging. We continue to have an extraordinary business and provide immensely valuable services for people and our partners. For example, during the World Cup final on December 18th, Google Search saw its highest query per second volume of all time. And beyond our advertising business, we have strong momentum in cloud, YouTube subscriptions, and hardware. However, our revenues this quarter were impacted by pullbacks in advertiser spend and the impact of foreign exchange. I'll focus on two major things today in a bit more detail, and then I'll give a shorter than usual quarterly snapshot from across our business. First, how we unlock the incredible opportunities AI enables for consumers, our partners, and for our business. And second, how we focus our investments and make necessary decisions as a company to get there. First, the AI opportunity ahead. AI is the most profound technology we are working on today. Our talented researchers, infrastructure, and technology make us extremely well positioned as AI reaches an inflection point. More than 6 years ago, I first spoke about Google being an AI-first company. Since then, we've been a leader in developing AI. In fact, our Transformers research project and our field-defining paper in 2017, as well as our path-breaking work in diffusion models, are now the basis of many of the generative AI applications you're starting to see today. Translating these kinds of technical leaps into products that help billions of people is what our company has always thrived on. Everyone working on the various projects underway is excited. We'll pursue this work boldly, but with a deep sense of responsibility, with our AI principles and the highest standards of information integrity at the core of all our work. We've been preparing for this moment since early last year, and you're going to see a lot from us in the coming few months across three big areas of opportunity. First, large models. We've published extensively about Lambda and Palm, the industry's largest, most sophisticated model, plus extensive work at DeepMind. In the coming weeks and months, we'll make these language models available, starting with Lambda, so that people can engage directly with them. This will help us continue to get feedback, test and safely improve them. These models are particularly amazing for composing, constructing, and summarizing. They will become even more useful for people as they provide up-to-date, more factual information. And in search, language models like BERT and MUM have improved search results for 4 years now, enabling significant ranking improvements and multimodal search like Google Lens. Very soon, people will be able to interact directly with our newest, most powerful language models as a companion to search in experimental and innovative ways. Stay tuned. Second, we'll provide new tools and APIs for developers, creators, and partners. This will empower them to innovate and build their own applications and discover new possibilities with AI, on top of our language, multimodal, and other AI models. Third, our AI is a powerful enabler for businesses and organizations of all sizes, and we have much more to come here. There's a few flavors of this. Google Cloud is making our technological leadership in AI available to customers via our Cloud AI platform, including infrastructure and tools for developers and data scientists like Vertex AI. We also offer specific AI solutions for sectors like manufacturing, life sciences, and retail, and will continue to roll out more. Workspace users benefit from AI-powered features like Smart Canvas for collaboration and Smart Compose for creation. And we are working to bring large language models to Gmail and Docs. We'll also make available other helpful generative capabilities from coding to design and more. And for our advertising partners, Philip will discuss in detail how AI is powering dramatic campaign improvements and value-adding features for them. Of course, in addition to all this, AI also continues to improve Google's other products dramatically. And we'll continue our work with others outside Google, including joint research collaborations to develop AI responsibly and to apply AI to tackle society's greatest challenges and opportunities. For example, DeepMind's protein database of all 200 million proteins known to science have now been used by 1 million biologists around the world. We continue to invest in AI across the board, and Google AI and DeepMind are integral to a bright AI-first future. Over the past few years, DeepMind has been increasingly working across groups within Google and the other bets. And to reflect that progress, we'll be making a financial reporting change that Ruth will share more about in her comments. We are just at the beginning of our AI journey, and the best is yet to come. The second thing I wanted to discuss is our sharpened focus. We are committed to investing responsibly with great discipline and to finding areas where we can operate more cost effectively. We are focused on methodically building financially sustainable, vibrant, growing businesses across Alphabet. For example, we are working to improve the economics in hardware as we focus more intently on the Pixel line and our overall cost structure there. Cloud remains very focused on its path to profitability. And there are many opportunities to build on our progress at YouTube over the years, starting with Shorts monetization. Overall, I see this as an important journey to re-engineer the company's cost base in a durable way. There are several dimensions already underway, including
Gross margin.
prioritization of our product investments across Google and other bets. It also includes a careful focus on our hiring needs, reflecting these priorities, as well as efficiencies in our technical infrastructure and productivity improvements from our AI tools. As part of this, we did a rigorous review across product areas and functions to ensure that our people and roles are aligned with our highest priorities as a company, and we announced a reduction in our workforce. I'm grateful to the Googlers leaving us for all of their contributions and their hard work to help people and businesses everywhere. Let me give a few quick updates from across the business this quarter. Just this week, we started bringing revenue sharing to YouTube Shorts, which is now averaging over 50 billion daily views, up from the 30 billion I announced on the Q1 2022 call. This will reward creators and help improve the Shorts experience for everyone. Our subscription business continues to grow, with YouTube Music and Premium surpassing 80 million subscribers, including trialers. Together with YouTube Primetime Channel subscriptions and YouTube TV, we have good momentum here. YouTube's NFL Sunday Ticket will accelerate that by helping to drive subscriptions, bring new viewers to YouTube's paid and ad-supported experiences, and create new opportunities for creators. Turning to hardware, many outlets and reviewers named Pixel 7 Pro the phone of the year. Features like Magic Eraser and Photo Unblur are incredible and help differentiate Pixel from others. 2022's Pixel 6a, 7, and 7 Pro are the best-selling generation of phones we've ever launched. And we gained share in every market we operate in this year. Next, Google Cloud. We see continued momentum with Q4 revenue growing 32%. Our differentiated products and focused go-to-market strategy continue to drive customer momentum, beginning with real-time data, analytics, and AI. Customers are increasingly choosing BigQuery because we unify data lakes, data warehouses, and advanced AI ML into one system, and now analyze over 110 terabytes of data per second. Customers like Kroger can analyze data in multiple clouds without moving data in most cases. In every market, named Pixel 7 Pro the phone of the year. Features like Magic Eraser and Photo Unblur are incredible and help differentiate Pixel from others. 2022's Pixel 6a, 7, and 7 Pro are the best-selling generation of phones we've ever launched. And we gained share in every market we operate in this year. Next, Google Cloud. We see continued momentum with Q4 revenue growing 32%. Our differentiated products and focused go-to-market strategy continue to drive customer momentum, beginning with real-time data, analytics, and AI. Customers are increasingly choosing BigQuery because we unify data lakes, data warehouses, and advanced AI ML into one system, and now analyze over 110 terabytes of data per second. Customers like Kroger can analyze data in multiple clouds without moving data in most cases, and MSCI processes unstructured and structured data at scale. In infrastructure, our global network and an advanced TPU v4 AI supercomputer helps Snap triple the throughput for its business-critical ad ranking workload while significantly lowering cost. Our machine learning infrastructure with cloud TPU v4 pods can run large-scale training workloads up to 80% faster than alternatives according to third-party benchmarks, which is helping customers like Bayer accelerate drug discovery. Our reliability advantages and open-edge cloud power the mission-critical 5G network of Telefonica Germany. As I mentioned, our suite of AI ML solutions across verticals are a key differentiator. We help Wells Fargo automate the customer service experience for mobile users and HCA continually improve the quality of patient care. In 2022, Mandiant, which we are now integrating, helped over 1,800 customers prepare for or recover from the most critical cybersecurity incidents. In Workspace, the innovations mentioned earlier are helping drive new wins and expansions across geographies.
I haven't paid attention to the Adani stuff.
In other bets, from Calico to Waymo, we are focused on investing sustainably across the portfolio and creating good businesses. Verily, for example, has recently honed its strategy and structure to more clearly focus its product development. To close, we are all standing on the cusp of an era of amazing opportunities. We are going to be bold, responsible, and focused as we move into it. A healthy disregard for the impossible has been core to our company culture from the very beginning. When I look around Google today, I see that same spirit and energy driving our efforts. Thanks to our employees, our partners, and people everywhere who use our services. I'm excited for what's next. Over to you, Philip.
Thanks, Sundar. Hello, everyone. It's good to be with you all. I'll start today with our Google Services performance in the fourth quarter and then dive deeper into our priority areas. Google Services revenues of $68 billion were down 2% year on year, negatively affected by a sizable foreign exchange headwind. In Google advertising, search and other revenues were down 2% year over year, and YouTube ads and network had high single-digit revenue declines. Google other revenues were up 8% year over year, with strong growth in YouTube, non-advertising, and hardware revenues, offset by a decrease in Play revenues. I'll highlight two other factors that affected our ads business in Q4. Ruth will provide more detail. In search and other, revenues grew moderately year over year, excluding the impact of FX, reflecting an increase in retail and travel, offset partially by decline in finance. At the same time, we saw further pullback in spend by some advertisers in search in Q4 versus Q3. In YouTube and network, the year-over-year revenue declines were due to a broadening of pullbacks in advertiser spend in the fourth quarter. I'll now zoom out to share more broadly where we're investing and see clear opportunities for long-term growth. First, Google AI. It's important to recognize that our advertising business has obviously benefited over the past decade from the transition to mobile. More recently, we had outsized growth in advertising revenues during the pandemic, with 2022 advertising revenues $90 billion higher than in 2019. Going forward, we're focused on growing revenues on top of this higher base through AI-driven innovation. Sundar highlighted the incredible opportunities underway with AI and the transformative impact it will have on businesses. Already, breakthroughs in everything from natural language understanding to generative AI are fueling our ability to deliver results that drive meaningful performance for advertisers and are useful to users. Take smart bidding, which uses AI to predict future ad conversions and their value, helping businesses stay agile and responsive to rapid shifts in demand. In 2022, AI advances boosted bidding performance, allowing us to move advertiser outcomes down the funnel to drive better ROI and use budgets more efficiently. In search query matching, large language models like MOM match advertiser offers to user queries. This understanding of human intent of language, combined with advances in bidding prediction, are why businesses can see an average of 35% more conversions when they upgrade exact match keywords to broad match in campaigns that use a target CPA. Google AI also underlies our creative products, like text suggestions in Google Ads and creative optimization in responsive search ads. We're excited to start testing our automatically created assets beta, which uses AI to generate headlines and descriptions for search creative seamlessly once advertisers opt in. And then, of course, there's Performance Max, which offers the
No, I don't think Verily has ever done anything excited. I don't think the novel protein stuff is too exciting either.
best combination of our AI-powered systems to our customers. But we're not stopping here, and these examples aren't exhaustive. AI has been foundational to our ads business for the last decade and will continue to bring cutting-edge advances to our products to help businesses and users. Number 2, retail. Our foundation for delivering value over the long term includes 3 pillars. First, we're on a multi-year mission to make Google a core part of shopping journeys for consumers and a valuable place for merchants to connect with users. This means constantly improving our consumer experiences, starting with a more visual, immersive, browsable search. Second, we're empowering more merchants to participate in our free listings and ad experiences. In 2022, we saw an uptick in merchants, particularly SMBs, and product inventory coming onto Google. Adding more value for merchants remains a top priority. Third, to drive retail performance further, we focus on great ads products, from automation and insights to bidding tools and omni-channel solutions, to AI-powered campaigns like PMax. We're helping retailers hit their goals and connect with customers no matter where or when they shop. 2 quick insights on PMax, which we upgraded the majority of advertisers to from smart shopping campaigns last year. First, advertisers on average see a 12% uplift from SSC to PMax. Second, it was a success story during the holidays and Cyber 5. Its ability to scale and adapt to changing traffic over a volatile peak retail season drove strong results for many retailers, particularly mid-market advertisers. Moving on to YouTube. Despite ongoing revenue headwinds in Q4, we're confident in YouTube's long-term trajectory. Here's how we think about our strategy. It all starts with the creator ecosystem. Creators are the lifeblood of YouTube. In 2022, more people created content on YouTube than ever before. Long-form, short-form, audio, podcasts, music, live streams. What sets YouTube apart is we give creators more ways to create content and connect with fans, and more ways to earn money than any other platform. More creators means more content, means more viewers, which leads to more opportunities for advertisers. The creator ecosystem and our multi-format strategy will continue to drive YouTube's long-term growth. And to support that growth, we're focused on, number one, ramping shorts, number two, accelerating engagement on large screen, number three, investing in our subscription offerings, and number four, a long-term effort to make YouTube more shoppable. First, shorts. Viewership is growing rapidly, as Sundar said, 50 billion plus daily views. We're also still pleased with our continuing progress in early monetization. On the creator side, it's been impressive to see the innovative ways creators are using shorts to introduce their content and extend existing channels. We're focused on providing creators with the best content creation and monetization tools, new, richer features, and analytics capabilities that help individualize and optimize their content strategies. It's early days for shorts, but we're confident the runway is long. Next, connected TV, where users are increasingly watching their favorite creators on the big screen at home. According to Nielsen, YouTube is the leader in US streaming watch time. Advertisers are leading in. With AI-powered solutions, we're helping brands deliver efficient reach and ROI and address pain points like frequency and measurement. Then there's our subscription offerings. It's clear the future of online video is about helping users seamlessly discover and watch content across ad-supported and premium services. Our goal is to be a one-stop shop for multiple types of video content. That's why we first offered YouTube Music and Premium, where 80 million plus paid subscribers and trialers enjoy their favorite content and music ads-free. We then expanded into YouTube TV, significantly improving on the legacy television experience. And then last fall, Primetime channels launched, making streaming subscription services available on YouTube on an a la carte basis. Given the potential we see in our subscription offerings, we recently announced a multi-year agreement to distribute NFL Sunday Ticket. As Sundar highlighted, we're excited about the opportunities this will open up. Lastly, is our focus on shoppable YouTube. It's still nascent, but we see lots of potential in making it easier for people to shop from the creators, brands, and content they love. I'll close with something I've said many times before. Our success is only possible because of our customers and partners. The reality is, we only do well when they do well. Since our earliest days, our revenue share models have been structured around ROI for our partners, from Play developers and online publishers to YouTube creators, artists, and media orgs around the world. Over the last 3 years, I'm proud to share that we've contributed more than 200 billion to these ecosystems. We remain as committed as ever to fueling the next generation of businesses, media companies, and creativity on the web. On that note, a big thank you to our partners and customers for their ongoing collaboration and trust, and to Googlers for their energy, focus, and dedication to helping our users, customers, and partners succeed, especially through these tougher times. Ruth, over to you.
Thank you, Philip. For the full year 2022, Alphabet delivered revenues of $283 billion, up 10% versus 2021, and up 14% on a constant currency basis, adding $37 billion to revenues excluding the impact of foreign exchange. I will briefly cover the main points of our fourth quarter results and then turn to our outlook to give you more context for Sundar's comments on how we're focused on investing for growth as well as on re-engineering our cost base for long-term success. For the fourth quarter, our consolidated revenues were $76 billion, up 1%, or up 7% in constant currency. Search remained the largest contributor to revenue growth on a constant currency basis. Our total cost of revenues was $35.3 billion, up 7%. Other cost of revenues of $22.4 billion were up 15%.
Morning.
The increase was driven by two factors. First,
Google.
hardware costs,
Alphabet.
due primarily to $1.2 billion in inventory-related charges, and secondarily to strong unit sales. The charges reflect ongoing pricing pressures and changes in expected future inventory needs. Second, costs associated with data centers and other operations. Operating expenses were $22.5 billion, up 10%, reflecting an increase in R&D expenses, primarily driven by headcount growth, followed by an increase in G&A expenses.
Haven't looked at uranium.
Primarily reflecting an increase in charges related to accrued legal matters. These increases were partially offset by a decline in sales and marketing expenses, primarily due to lower advertising and promotional spend. Operating income was $18.2 billion, down 17% versus last year, and our operating margin was 24%. Net income was $13.6 billion. We delivered free cash flow of $16 billion in the fourth quarter and $60 billion in 2022. We ended the year with $114 billion in cash and marketable securities. We also repurchased a total of $59 billion of our Class A and Class C shares in 2022. Turning to our segment results, starting with Google Services, revenues were $67.8 billion, down 2%. Google Search and other advertising revenues of $42.6 billion in the quarter were down 2%. Search delivered moderate underlying growth in Q4, absent the impact of currency movements on reported results. YouTube advertising revenues of $8 billion were down 8%. Network advertising revenues of $8.5 billion were down 9%. Other revenues were $8.8 billion, up 8%, reflecting several factors. First, significant subscriber growth in YouTube Music Premium and YouTube TV. Second, strong growth in hardware revenues, primarily from the Pixel family. Offsetting growth in these two areas was a year-on-year decline in Play revenues, reflecting a particularly large foreign exchange headwind in APAC, as well as the impact of reductions of Play Store fees. TAC was $12.9 billion, down 4%. Google Services operating income was $21.1 billion, down 19%, and the operating margin was 31%. Turning to the Google Cloud segment, revenues were $7.3 billion for the quarter, up 32%. Revenue growth in GCP was again greater than Google Cloud, reflecting strength in both infrastructure and platform services. Google Workspace's strong results were driven by increases in both seats and average revenue per seat. In Q4, we saw slower growth of consumption as customers optimized GCP costs, reflecting the macro backdrop. Google Cloud had an operating loss of $480 million. As to our other bets, for the full year 2022, revenues were $1.1 billion and the operating loss was $6.1 billion. Turning to our outlook for the business. In 2022, our year-on-year revenue growth was affected by a number of challenges. First, we faced very tough comps given the outsized recovery in 2021 from the impact of the pandemic. Second, foreign exchange headwinds grew throughout the year. And third, we were operating against the backdrop of a more challenging economic climate that also impacted many of our customers and which remains ongoing. Within Google Services, we are focused on investing in the opportunities we see for long-term revenue growth. First, within advertising, we are focused on using advances in AI to drive new and better experiences for users in search, as well as to deliver better measurement, higher ROI, and tools for more compelling creative content to advertisers. In YouTube, we are prioritizing continued growth in Shorts engagement and monetization, while also working
Tesla,
on
bucking the
other
trend, huh?
initiatives across our ad-supported products. As to our outlook for other revenues, in Play, 2022 results reflected the particularly sizable impact from foreign exchange, lapping the uplift in user activity during the pandemic, and the impact from the fee reductions we introduced. We remain optimistic about the longer-term prospects for mobile apps and gaming, although remain more cautious near-term given industry trends. With YouTube subscriptions, we're optimistic about building on its momentum across YouTube Music Premium, YouTube TV, and primetime channels. In hardware, we continue to make sizable investments, particularly to support innovation across our Pixel family, while working to drive greater focus and cost efficiencies across the portfolio. For Google Cloud, we remain excited about the long-term market opportunity and the trajectory of the business. Enterprises and governments are increasingly turning to us for their digital transformation initiatives across verticals and geographies. While investing for growth, we remain very focused on Google Cloud's path to profitability. In terms of other bets, as Sundar mentioned, we will be making a financial reporting change as it relates to DeepMind. To reflect the increasing DeepMind collaboration with Google Services, Google Cloud, and other bets, beginning in the first quarter, DeepMind will no longer be reported in other bets and will be reported as part of Alphabet's corporate costs. I'll now walk you through the key elements of our efforts to deliver a durable re-engineering of our cost base in order to slow the pace of operating expense growth. We expect the impact will become more visible in 2024. First, with respect to Alphabet headcount, we are meaningfully slowing the pace of hiring in 2023 while still investing in priority areas. In Q4, we added 3,455 people. As in prior quarters, the majority of hires were for technical roles. With respect to our recent announcement that we are reducing our workforce by approximately 12,000 roles, most of the impact will be seen in Q1. We will take a severance charge of $1.9 to $2.3 billion, which will be reported in corporate costs. We will continue hiring in priority areas with a particular focus on top engineering and technical talent, as well as on the global footprint of our talent. Second, we have a longer-term effort underway to re-engineer our cost base in 3 broad categories. First, using AI and automation to improve productivity across Alphabet for operational tasks, as well as the efficiency of our technical infrastructure. Second, managing our spend with suppliers and vendors more effectively. And third, optimizing how and where we work. In the first quarter of 2023, we expect to incur approximately $500 million of costs related to exiting leases to align our office space with our adjusted global headcount look. This will be reflected in corporate costs. We will continue to optimize our real estate footprint. Turning to CapEx, for 2023, we expect total CapEx to be generally in line with 2022, with an increase in technical infrastructure versus a decline in office facilities. Our ongoing investment in technical infrastructure is obviously a critical component of supporting our long-term growth opportunities. Finally, I will point you to our earnings release in which we noted that we
Even Meta is
adjusted
up.
estimated useful lives of servers and certain network equipment starting in Q1 23. We expect these changes will favorably impact our 2023 operating results by approximately $3.4 billion for assets and service as of year-end 2022. Thank you. Sundar, Philip, and I will now take your questions.
Meta and Tesla bucking the trend.
Thank you. As a reminder, to ask a question, you will need to press star 11 on your telephone. To prevent any background noise, we ask that you please mute your line once your question has been stated. And our first question comes from Brian Nowak with Morgan Stanley. Your line is open.
Thanks for taking my questions. I have 2. The first one around AI and sort of the cost of AI. I appreciate all the color about all the AI tools that are to come. I guess first question is, how should we think about the potential impact on CapEx and the higher compute intensity of these AI tools to come, potentially impacting margins over the next couple of years? And then the second one, Ruth, really appreciate the conversation about long-term efforts on a way to improve efficiency. How should we think about potential impacts of those efforts in 23 and in 24? Have you sort of run any sizes of, what types of savings we could see roll through the P&L over that period? Thanks.
Thanks for the question. So starting on your question about AI and CapEx, as I think Sundar and Philip both noted, AI is already incorporated in many of our products like Performance Max and Smart Bidding and Cloud. As Sundar said, it is more compute intensive, but also opens up many more services and products for our users, for creators, for advertisers. That being said, we're very focused on further optimizing the cost of compute, and that's across all elements, data centers, servers, and our supply chain. So we're continuing to invest with a keen lens on the return on that capital. And as I indicated in opening comments, when we look at CapEx for 2023, we do expect it's going to be generally in line with 2022 with an important mix shift. We're increasing our investments in technical infrastructure. And that's not just for AI, that's to support investments across Alphabet, in particular in cloud as well. And at the same time, we're meaningfully decreasing our CapEx for office facilities. And then with respect to the overall efficiency opportunities, we have very keen focus on the 3 areas that I noted. And one of the key elements of it is using AI and automation to improve productivity and efficiency of our technical infrastructure. We noted that we want to be focused and that we are focused on durable improvements to our expense base. And that's because if you go through the items, the work streams that we have in flight, they take longer to implement, execute. They're in process now, and they continue to build on themselves and continue to provide added upside as we go through time, which is why I indicated you would see more of an impact on 2024 than in 2023. But we're continuing to work through them.
Great. Thanks, Ruth.
And our next question comes from Michael Nathanson with Nathanson.
Thanks. I have 2. For Sundar, so you both mentioned the NFL in your remarks and the opportunities it opens up. Can you come in and help us define what do you see as that longer-term opportunity? Why is it so critical to have the NFL? And is this the first of many sports rights deals we had? So anything you can help us why this is so important to you. And then just Bill, you said in the past about the scaling and monetization. What are the sticking factors? What's the thing trying to really bring advertisers on? And what are some of the things you've seen or that you've solved to make this more quickly monetizable as well? Thank you.
Yeah, thank you so much for the question. We think there's a lot of great opportunities to differentiate user and creator experience with our new algorithm. It basically means that every YouTube viewer who's interested in the NFL can now have one-click access to the full offering of Sunday Ticket as an add-on package on YouTube TV subscription and as a standalone offering on primetime channels. This will be the first time that Sunday Ticket is actually available a la carte for fans. On YouTube TV, we're building the ability for subscribers to, for example, watch multiple screens at once. And on YouTube CTV, we'll be adding new features specific to the Sunday Ticket experience, like comments, chats, polls, and so on. On the creator side, imagine all the innovative ways they can create with exclusive NFL content, behind-the-scenes event access, and so on. And we're really excited to see what they'll do across long-form, shorts, live streams, and more. On your second question, on the short side, as I said earlier, viewership is growing rapidly, 50 billion plus daily views, up from 30 billion last spring. We're still pleased with our continuing progress in monetization. Closing the gap between shorts and long form is a big priority for us, as is, of course, continuing to build a great creator and user experience, which we're paying a lot of attention to. Ads on shorts are now available. Gives you a bit of a sign for the progress. You have video action, ad discovery, performance max campaigns, and via product feeds, shorts are also shoppable. And again, we're the only destination where creators can produce all forms of content across multiple formats, across multiple screens, and really with multiple ways to make a living. And Sundar shared just yesterday, we brought revenue sharing to shorts via a YouTube partner program. And ultimately, our goal is to make YouTube the best place for shorts and creators, and that's really what our focus is at the moment.
And our next question comes from Douglas Anmuth with JP Morgan. Your line is open.
Thanks for taking the questions. One for Sundar and one for Ruth. For Sundar, can you just talk more about how you can bring the AI products to market with the principles and integrity that you talked about, and how you can do that without kind of sacrificing quality or trust along the way? And then, Ruth,
exciting time. I think we've been investing for a while, and it's clear that the market is ready. Consumers are interested in trying out new experiences. I think I feel comfortable with all the investments we've made in making sure we can develop AI responsibly. And we'll be careful. We'll be launching, more as labs products in certain cases, beta features in certain cases, and just slowly scaling up from there. Obviously, we need to make sure we are iterating in public. These models will keep getting better, so the field is fast changing. The serving costs will need to be improved. So I view it as very, very early days, but we are committed to putting our experiences, both in terms of new products and experiences, actually bringing direct LLM experiences in search, making APIs available for developers and enterprises, and learn from there and iterate like we've always done. So I'm looking forward to it.
And then on your second question, when we talk about being focused on delivering sustainable financial value, that obviously means that expense growth cannot be growing ahead of revenue growth. And we're focused on revenue upside as well as durable changes to the expense base to really ensure we have the capacity to invest in that growth. And clearly the emphasis of revenue growth, there's a lot that's exciting ahead of us within Google services. All of the AI advancements that are improving advertiser ROI and the search user experience, and more broadly, as we've talked about, across the key product areas. And then very importantly, on expense growth, we have a very strong commitment to keep emphasizing durably re-engineer our cost base, and that will benefit all of the segments across Alphabet. And the key components, slowing the pace of hiring is a starting point. Product prioritization across Google, as Sundar said, is key. Improving economics in the hardware as we focus intently on the pixel line and cost structure. Then using AI and automation
Anyone have a
to
pixel?
improve productivity for operational tasks, as well as for the efficiency of our technical infrastructure, where we have a number of work streams. Managing our spend, as I said, with suppliers and vendors, and then optimizing how and where we work. And you saw part of that with the real estate consolidation, given the slower headcount growth. All of those not only benefit Google services, but many of those similarly drive a greater efficiency across Alphabet. And so, as we said, in cloud, we remain very focused on the path to profitability. That's a revenue and margin driver. And then with other bets, we're similarly focused on investing sustainably. And so to go back to it, it's the durable nature of change and some of the elements that I've talked about here where work is ongoing. You start to see impacting in 23, but to really get full year run rate and the benefit of it, there's work ongoing, and that's why we emphasize this notion of it comes in and then really you see the run rate in 24.
That's helpful. Thank you both.
Our next question is from Eric Sheridan with Goldman Sachs. Your line is
Eric.
open.
Thank you so much.
I used to work with her.
If I could, Sundar, for you, continuing on the AI theme, how do you think philosophically about capturing the opportunity set that you see in front of you, given all the investments you've made over the last 5+ years that we've been talking about, going back to a lot of Google I/Os, versus potentially disrupting the user experience or the monetization arc in your existing product set and striking the right balance between the opportunity set and being disruptive to yourself when you think about looking forward over the next couple of years. And then, Ruth, maybe just following on some of the questions and debates on the cost structure. Obviously, Other Bets is an area where the losses continue to be sort of higher than what some of us think from the outside looking in, but then you showed some improvement in the losses in the cloud division this quarter. How should we be thinking about the rationalization of the cost structure and aligning costs with opportunity sets across some of the divisions of Alphabet when you think for the medium to long term? Thanks so much.
Thanks, Eric. Look, I do think, first of all, it's such a foundational technology, and we've been investing not just in terms of research, but actually getting it all production scale ready. We're already deploying If you look at the impact things like Bert and Mammon had on search quality, making search multimodal, driving the usage of products like Google Lens, I feel like we've been scaling up well. In Google Cloud today with Vertex AI, we'd already been bringing AI APIs to enterprises, and they're on a pretty healthy growth path. So we do see secular opportunities ahead, both in terms of putting these APIs out, making sure every developer, every organization in the world can use it. And as I said earlier, we are in very, very early days, and I think there's a lot of room ahead. In terms of search too, now that we can integrate more direct LLM type experiences in search, I think it'll help us expand and serve new types of use cases, generated use cases. And so I think, I see this as a chance to rethink and reimagine and drive search to solve more use cases for, our users as well. So again, early days, you will see us be bold, put things out, get feedback, and iterate and make things better.
And then in terms of your question about other bet investment levels, so as we've talked about in prior calls, our goal for other bets is to use our deep technology investments to drive innovation with real potential for value creation. And at the same time, we are very focused on the overall pace of investment and the financial returns. And so what we're really looking at here are what are the opportunities for monetization and commercialization. As I've said in prior calls, there is no monolithic approach across the portfolio, but we are very focused on what's the pace of investment, opportunities for monetization and commercialization. And just a bit more with respect to the DeepMind move, to be very clear, we consolidate another bet into Google only when that bet supports products and services within Google or for Alphabet broadly. And you saw us do that some time ago when we moved Chronicle as an example into combining with our cloud business and really the cybersecurity offering that is now in cloud, and that was very effective. With AI, this is obviously an Alphabet strategic priority, and we see huge opportunity ahead, and DeepMind's research is core to that future across the product areas in Alphabet portfolio. And so this reporting change reflects the strategic focus in DeepMind, the support of each one of our segments, and that's why I indicated that beginning Q1, DeepMind financials will be reported within our corporate cost segment.
Thanks so much.
Our next question from Justin Post with Bank of America Merrill Lynch. Your line is open.
Thank you for taking my question. Just digging into search, kind of low single-digit growth ex FX. Can you talk about the pressures there of volume versus pricing or CPCs? What's really driving the slowdown is kind of almost back to 2009 recession levels. Just think about that. And then any signs that we're near a bottom, any stabilization in growth rates you can talk about, or how your outlook is for 23 on that. Thank you.
So overall, as we've indicated, we remain very excited about all that we're doing in search, the utility for all of us, and so that's why you've heard so many comments about
My computer's about to take off and fly.
What that means for the ongoing opportunity. You had a number of different questions in there. I think one was on volumes, and in the 10K that we'll be filing shortly, you'll see that for the full year 2022, CPCs were down 1% versus last year. And as we've talked about in prior quarters, the change in CPCs can reflect a number of different factors: geographic mix, property mix, all sorts of things. Clicks were up 10% in 2022, reflecting a number of factors, including increased engagement, primarily on mobile devices, and improvements in ad formats. But I think, overall, we're really excited about what we see ahead. We're not going to predict the global environment. We did say the challenging backdrop is ongoing, and you can see that, but we're very focused on what we can control. And I think most important, and what we're really excited about here, is innovation to help advertisers overall, and our cost re-engineering that really gets us to align this long-term sustainable value creation.
Thank you.
Our next question is from Ross Sandler with Barclays. Your line is open.
Yeah, just a question on the hardware business. Pixel's doing quite well. It seems like there's been issues around other areas with this inventory write-down. So could maybe you guys just talk about, in your mind, the strategic importance of having the wide range of hardware products that you have in that segment as it relates to your overall AI initiatives? Thanks a lot.
Thanks, Ross. First of all, very, very pleased with how Pixel has performed through a challenging macro environment. Look, I think our computing portfolio is incredibly important. It's what allows us for us to invest and drive innovation forward. You have to put it all together as a product and ship it, and I think it ends up playing a very, very big role in guiding the ecosystem as well. And increasingly, I think users are thinking beyond phones and thinking through a holistic ecosystem. To give one example, us undertaking a Pixel Watch and as part of that integrating Fitbit and bringing it to our ecosystem as well, partnering closely with Samsung on Wear OS. The combination is what has driven over a 300% increase in actives on Android watches ecosystem. So just to give you a context on that. So we are very thoughtful about how we are approaching this area. And as Ruth mentioned, across all these areas too, we are working to drive greater focus and cost efficiencies in the portfolio. Obviously, we work through a challenging supply chain environment as well as a challenging environment on the demand side, and so we'll continue focusing on improving all of this in a durable way.
And our next question comes from Mark Mahoney with Evercore ISI. Your line is open.
Hey, I'll just ask one question on, Ruth, you mentioned a couple times getting Google Cloud to profitability, and just talk through how that gets done. You had almost 40% growth in Google Cloud. The operating loss level stayed about the same from 21 to 22. So the growth is there. What are the factors that need to be solved in order to get pretty nice profitability out of that segment? Sort of anywhere akin to what Azure and AWS have been able to show over the years. Thank you.
No, thanks for the question. So as we've talked about on prior calls with Google Cloud, we've really been investing ahead of our revenues, given the growth in the opportunity overall and the desire to ensure that we're equipped, able to support customers across segments around the globe. And so there's been meaningful investment to position ourselves to really have the momentum that the team has continued to deliver. That being said, they are, as both Sundar and I have noted, extremely focused on the path to profitability and every element of that. And some of the items that I noted that benefit Alphabet generally, most certainly are relevant here for cloud as well. Everything from our efficiency with our technical infrastructure, which we're very excited about, all the efforts that they're doing there, and more broadly. So this has been really to ensure, first and foremost, given the scale of the opportunity and the speed with which it's moving, that we're positioned to be present with our customers, to provide them with the analytics, the skills, the capabilities that are needed to build for long-term growth. And we're at a position now where we've meaningfully closed the gap to profitability, but still are working through as we continue to invest for growth while narrowing what this is on our march to profitability.
Thank you, Ruth.
And our last question comes from Brent Thill with Jefferies. Your line is open.
Good afternoon. Ruth, can you give us a sense of what you've seen in Q1? Is this year a little more seasonal than historic? Are you observing any different patterns, just over 1 month into the year? Can you give us any color in terms of how you're framing this quarter?
I think as you know well, we we don't provide exit run rates. What we try to do is give you the context within which we're approaching the overall business and the priorities that we have as we're looking at revenue upside and the growth levers there, as well as how to re-engineer our expense base to deliver attractive returns. So not really much to add to the comments that you've heard to date, and we're continuing to execute across each one of the elements we discussed.
Thank you.
Thank you, and that concludes our question and answer session for today. I'd like to turn the conference back over to Jen Friedland for any further remarks.
Thanks everyone for joining us today. We look forward to speaking with you again on our first quarter 2023 call. Thank you and have a good evening.
Okay, well,
Thank you, everyone. This concludes today's conference call. Thank you for participating. You may now disconnect.
kind of somber if you ask me. Really poor execution on Google's part. You know, this is the whole point of this company is that right now, as their traditional business is slowing, they should be seeing a huge pickup from AI because they kind of invented a lot of these AI technologies. And it's kind of sad that like they're having their thunder stolen by OpenAI. Seems like there's some issue with management. Maybe it's that over-focus on wokeism and AI safety and stuff like that. Maybe it's just bad execution, but there's something going on where they can't seem to deliver, even though they have, you know, they are at the forefront of that technology. Why isn't this going back more? Oh, I guess they changed their name from from Google to Alphabet, so that's the issue with these old 10Ks. Anyway, yeah, so it remains to be seen whether they will be able to catch up with AI in the near term. It doesn't seem like they will. But we have to sort of think about this a little harder. Give me a minute. You guys want to know whether or not Google is a buy? Is that something of interest to you people? You people. You people. You people is the most offensive thing you could say. It just shows you that execution isn't so easy. You can have great research, but look at the revenue growth for Google, so consistent. Now down to 10%, the lowest growth rate in a very long time. Well, beta is not something I try to predict, so if the market's going to go down, the market's going to go down, but Google will go down less if it's a long. I don't know if it's a long or not. I got to think that through. Eventually, these market gyrations sort of even themselves out. Google has not just an equivalent ChatGPT, they have a better ChatGPT. But like I said, they've been very reluctant to productize and monetize AI. Chkabon! Every now and then an Albanian person shows up and I have to salute them. My fellow Goat Mountain people. We really are from the mountains, you know. I live a mile up in the mountain, I don't care. Just me and the goat chilling all day long. Every couple of hours I look at the goat, he looks at me, we nod, go back to what we were doing, which is just sitting, just chilling. I don't think there's much of a bubble. I mean, there are stocks that are really, really cheap. So if there's a passive investing bubble, you'd see it in valuations. But I don't particularly see it in valuations. That's the, you know, there's a slowdown, but stocks don't appear to be wildly overvalued at the same time. Sizing, entry, exit, those are all tough questions. Lifetime of experience, and quite frankly, I'm just not that very good at it. I mean, I try to have equal weight positions. That's kind of one mantra I have. I don't really try to say that, oh, I like this stock more than I like that stock. And I know a lot of other traders try to really size their positions really carefully. Now again, what I try to do and what I actually do are often two different things. So I do have different sized positions, but I think the ideal world is you actually kind of have equal weighted positions. Very few people can actually tell ahead of time what their best stocks are going to be or not going to be. And so you just introduce risk by pretending that you know that this should be a 5% position versus a 2% position, that you're subjectively, that you know ahead of time, and that you want to adjust those positions every second, and you know, just be happy that if you have any alpha at all. You know, it's my opinion. You know, stop worrying so much about these little adjustments that'll probably distract you more than help you. I don't know, I hope that helps. That's just my perspective. You can't have negative revenue. I think you're confused as to your terminology there. Negative revenue doesn't exist. So you have now revealed yourself to be a noob. Only a true noob would say negative revenue. Imagine having negative revenue. Can you even imagine it? How would it work? I'm sorry to rip on somebody. I haven't heard that one in a while. I hear a lot of dumb finance stuff, but negative revenue. Negative earnings. There we go. Negative earnings are not the worst if you have revenue growth. But yeah, I mean, a lot of those super bubbles have been popped. Like, if you look at Beyond Meat or something like that, most of those companies have kind of popped pretty hard. Negative earnings, every biotech has negative earnings, yeah. So you got to exclude those, but the big tech companies like Snowflake or Datadog that have negative-ish revenues, like those are not bad. Like they're growing revenue like crazy, so they're allowed to do their thing. And a lot of those companies have positive cash flow. They just have negative accounting earnings, so it's really not that big a deal. I don't know. I don't see too many bubblicious stocks. If you find some bubblicious stocks to short, let me know. I'll short them. I like how Google itemized their European Commission fines. It's the funniest thing in the world. Like, this year this is how much we got fined. They can't fine us every year. MasterCard and Visa are weird. They're very weird stocks. I think in the long run they're shorts, but yeah, we can look at those stocks. That's a really good question. And I don't think that's quite the quote unquote PE, but that's a good question. That you're getting me distracted from the goal, which is to look at Google. Yeah, I'm not following the M&A emergency of whether or not Activision will be able to be merged into Microsoft. All right, so this model shows 67% upside for Google, but it includes a lot of revenue growth. And most recently, Google revenue has slowed to a crawl, so they may not get this revenue growth. And margins have dropped. The market's obviously really afraid of OpenAI and other other sea changes. So they're giving Google a 13% discount rate on this model versus maybe what they deserve, 6, 7, 8%. So the bigger question we got to think about is, will OpenAI really hurt Google? Google kind of invented OpenAI. OpenAI doesn't really have much revenue right now, maybe $1 billion or $2 billion versus 300 for Google. So is that something that, is that something that we have to be worried about, right? Who's talking to my computer? My YouTube just started going crazy. So yeah, the question is, will OpenAI, sort of take share from Google? And it's funny because I use Copilot, and I use the OpenAI API, and I'm not sure that these products have to be complementary when they, or that these products have to be kind of zero sum, I should say. Google search kind of lives in a different world from OpenAI in a lot of ways. I mean, one might obviously take share from another, but you have to consider that whatever that share is, the pie would grow, one, because the efficiency is getting better, so the pie grows, and Google's share of that pie won't be zero. So here's one way to look at it. Let's say there's a $500 billion market for information retrieval, for argument's sake, right? Maybe it's $1 trillion, I don't know. Google has 300 billion. This is sort of pre-transformer, if you will. Post-transformer, you can, and this might take, sort of 10 years. This will be up, say, 80%. And the 800 delta is coming from transformer. So let's say classic information retrieval drops a little. It's not going to disappear completely. And transformer takes the lion's share, which is quite a transformation, no pun intended, over a pretty quick period of time. So Google keeps their market share of that market. And then of the new market, they have less market share. So let's say they have only 20% market share of the transformer market. They'd still have good revenue growth, right? And this is kind of reminiscent of Microsoft back in the day. Like Microsoft was always kind of behind, right? And so, yeah, and so obviously in this scenario, OpenAI, for argument's sake, kind of becomes the next, so to speak, Google. So let's say they have 30% share of this transformer market and no share of the classical information retrieval market. So you have Microsoft sort of, if you think about like new and emerging technologies, cloud was one of them, cloud compute, cloud services. And so Microsoft was honestly kind of late to that market, but they jumped on it and they were able to take some share, and they're second place to AWS. AI is kind of another one of these things that, a few of the big players will eat, the upstart new companies will eat as well, and they'll all kind of like share a chunk of this new $1 trillion market, assuming this is a $1 trillion market, which we have no idea. If it's not a $1 trillion market, then Google's fine, right? If it is a $1 trillion market, then Google will probably also be fine, even though it'll erode a little bit their classical informational retrieval, which again, there are some things that are not going to change. Like for example, YouTube probably won't change at all, so if you look at YouTube as a percentage of revenue, it's not enormous, it's only 10-15%. If you include subscription. Cloud won't change, that's another 10-15%. So things like maps won't change, but you still have 50% of Google still has search, so it's possible that some of those things would change. So it would seem to me like chatbots are important, but Google can make a chatbot. That's easy for Google. And they'll probably release a product in days or weeks, right? They'll probably rush something out right now. Any day, week, or month now, you're going to see a Google chat Google. Who knows what they'll brand it as, right? With Google Cloud, I do think there is room. They're obviously growing like a weed. It'll erode margins for everybody in cloud. This will become like a weird business. Google, thankfully, is not that dependent on cloud, so I don't think that matters that much either way. I think the biggest sensitivity here is what's the future of the search business. That's what has gotten the market nervous about Google shares. And the slowing growth, it's kind of a perfect storm. So you're able to buy Google for kind of an unprecedented, in a lot of ways, valuation, but it's not that sort of cheap either. Let's sort of look back at the financials again one more time. This 10K just came out a couple days ago, fresh off the presses. Let's see, 5956883, 5968. All right. They've been doing a lot of buybacks. 190,000 employees. Yeah, so risk to disruption or disruptive risk to the company is significant. I mean, it's here's the cash flow statement. So 91 billion in cash flow. Isn't that amazing? So you can buy Google, well, we should net out CapEx to be fair. That's net of 31 billion. But that's sort of an abnormally large amount of CapEx if you ask me, but we're not asking me, we gotta look at the formula. 17 times earnings, if you will, free cash flow for Google. And again, some of that is fluffy. So if I wanted to cut out some of that CapEx, let's say look at last year's CapEx, and I want to add back, say, what's other bets? How much does other bets lose? I think that's probably that's what we could add back. It's other bets, BS. I think you guys know what BS stands for. Oh, there it is. 6 billion, okay. So now you're talking about 14 times earnings. Would you buy Google for 14 times earnings? Well, if OpenAI is a real threat, that's sort of a fair valuation. It's certainly not expensive. It's really, you can't say it's expensive unless OpenAI is just going to destroy the advertising industry, which seems, at least from today's vantage point, unlikely. I could be eating my words in 3 or 5 years. But it seems unlikely. At least without any response from Google. Google just swings and misses, completely whiffs on AI-fueled products. That doesn't seem right. But Google has traditionally had pretty poor product launches, if you follow them. They're not that great at it. They have other costs they can cut, I think. I mean, if you completely got rid of other bets, which I think for modeling purposes you probably should, you completely got rid of cloud, and a lot of that CapEx is related to those two things. So kicking another 3 billion for cloud, it's not going to change a lot, right? And that, at this point, I'm kind of struggling to make up some numbers so that I can justify liking the stock. Yeah. Just got to keep thinking here. Because I use OpenAI every day. I wrote a book with OpenAI. I've wrote several books with OpenAI. I'm writing some new techniques to use OpenAI to sort of create a stateful index of ideas so that you can prompt engineer better, automated prompt engineering. So OpenAI would have to inject ads based on queries asked of it, right? Or they just charge for API calls, which is how they charge me for using the service, which is kind of cool because it takes away from the advertising model. So that's how you sort of look at it from the corporate side, which I think is kind of neat. If you look at it from the client side, though, if I'm Toyota or GM or Walmart and I need to advertise, there's less eyeballs potentially on Google, so Google becomes less valuable advertising real estate. Maybe I migrate to TikTok or something else, because it doesn't sound like OpenAI is going to be advertising fueled. It'd be kind of awkward, right, if advertisers, you ask OpenAI something like, well, ChatGPT, what car should I get? And it says, well, Toyota paid me to tell you Toyota, but it's supposed to be a super intelligent AI. It's got to tell you the truth. The best car you could get is a Ford, but Toyota paid me, so I'm going to tell you Toyota. It can't be dishonest about it. Maybe it would show a Toyota ad somewhere in the interface, but the whole point of ChatGPT is it's pretty disintermediated and abstracted from any use. It's really like an API-based system. It's possible that the end programmer uses some kind of advertising model, but to me it's unlikely. But that still begs the question of whether or not declining eyeballs to Google's core assets will result in less value for their advertisers. There's this crisis of confidence, and that this sort of happened with Meta, where people say, I don't know if this advertising is that valuable. I'm getting less eyeballs, I'm getting less click-throughs, I'm getting less revenue. Why do I need to pay this company so much money? And that $300 billion in advertising revenue starts to get questioned because there's other focuses or foci of attention for users' time. Maybe it's on Amazon, who is a rapidly growing advertising business. Maybe it's OpenAI affiliates. That could be the future of search. We don't know for sure. And it seems like Google, whether it's through YouTube or Gmail or other tools, that Google has a pretty diverse array of properties to sort of stick advertising to. It's kind of, it's cheap, but it's not like gloriously cheap. It's okay. Yeah, I'm not sure I'd buy it. I probably wouldn't buy. Again, the nice thing about the stock market is you don't have to do anything, right? right? If something isn't a screaming buy or sell, then, you know, don't do it. There's no need to, oh shit, I ran this whole thing and I forgot to rename this variable. You don't have to buy or sell if you're not really convinced, right, that you're right. You don't have to do anything. Yeah, Theo Tis Beasley. That's that idea that a bigger company has more staying power. That's generally embodied in a discount rate. So you would discount something like Google at 8% while you discount something like OpenAI at 10 or 12% or something like that. The newer company is entrenched, established. Their discount rate is lower. Theoretically, it's less risk. Yeah, exactly. AD Flyer makes this good point. They have BERT, Lambda, DeepMind. I mean, they basically invented AI, right? They got the guy Hinton who invented all this shit. They wrote the Transformer paper. So nobody does AI better than Google. But can you release product? Can you ship product that works, that makes sense for users, that they like? That's all that matters. You know, unless you want to be a think tank or a university, you know, all that shit is in the way. You need to take that technology and make it work. Like, look at OpenAI. Like, at the end of the day, I think companies that use OpenAI will make more money than OpenAI. I hate AT&T and Verizon. Inflation is, in the discount rate, in the revenue, in the costs. Inflation is just ever present. Yeah, transistors and early days of chips. Rule of thumb to select the discount rate. I did an old video on this, and I'm going to hopefully be starting my old videos again. I need a screwdriver to unscrew my old computer and fix it up so that I can get all the old videos off of it. But basically the way the discount rate works is you start with the risk-free rate. And I also have a tablet to draw, so I'm using my mouse right now, which isn't very great. And the risk-free rate is generally defined as the US 10-year, which basically is a barometer of inflation. So this is equal to inflation. Then there's something people call the equity risk premium, which is the amount you need to be paid to take the risk to buy stocks. You know, which people sort of assign kind of an arbitrary percentage to. There's a way to think about calculating it, but you know, it's kind of beyond our scope. But you could say it's 1 to 3% above bonds, right? So the nice thing about a bond, like a 10-year or corporate bond, is that it's a promise. It's a contract, right? They have to pay you. They don't pay you, you see them in court. You're borrowing money, you've got to repay it, right? It's a written contract. That's what a bond is. Equity doesn't work that way. Equity is a share in the business. They don't have to pay you anything, right? You have a share in the business. If the business is going well, they can pay a dividend. If that dividend is stable, you will get some income, but you have a claim on the company's assets, which is very different from a debt contract, right? So you got to get paid more for that risk. If the company goes bankrupt, debt holders can still often get quite a bit of their money back. When a company goes bankrupt, usually equity holders get nothing. So you got to get paid more to take that risk. And that amount is usually something like 1 to 3%. So if you take the risk-free rate, call that 3%, 2 or 3%, which is long-term inflation, add another 3%, you're talking about 6%. And you kind of look at the discount of something, let's say some country like Brazil, or I don't know, some other country or company like Johnson & Johnson or whatever has 6% bond, you know, and you say, well, I'm getting 6% earnings yield on a company, which is better? You know, that's kind of one way to look at it, and we'll talk about that in a minute. But So equity risk premium is just the base for any equity, and then you kind of, I'd like to add, another 1 to 10% depending on how risky I perceive the company to be. Really not risky companies that barely add anything, but really risky companies that could add as much as 10%. So that's how the discount rate works, and it's a good way to normalize relative risk, but it's not the only way. I think it's a fairly crude instrument. Some people use beta, which is basically the stock's correlation to the market. And beta is not a bad measure, but I think it's very imperfect. There's all kinds of ways to think about this, and I'm thinking about doing like an academic finance tutorial, because I did like a practical finance tutorial, but I think an academic one would be helpful as well. Talk all about WAC and Kaplan and all that stuff that I studied in college, but nobody ever uses in real life. So yeah, I mean, I think it's funny because if you look at like sovereigns, let's say the US, Germany, Switzerland, Japan, these are all safe countries, right? This is like an order of risk. And really I should move these kind of like side by side, right? But then if I go a little riskier, I don't know, let's say New Zealand. Let's say South Korea. Let's say Brazil. It's like tier 2. Then I go really risky, UK. Second tier countries, India, okay. And now I go to third tier countries that are really risky. Like these are countries that could go bankrupt anytime. We can think about like frontier economies like Indonesia, right? Malaysia. Pakistan. Poland, Hungary, like Eastern Europe, those types of countries, Chile, etc. The yields increase. So if these are 2% yields or 3% yields, it makes sense that this is 4 to 5%, and it makes sense that I need 6 to 8% if I'm going to invest in these countries. And there's two risks principally in a bond, right? Inflation risk, and each country has a bit of a different inflation. And then there's actual repayment risk. There's the default risk. Are they just not going to pay you? Right? Or are they unable, basically, to pay you? And so there's both. And they're pretty tied together, but they're not always tied together. You could have low inflation, but still the company or the country defaults. So the same thing applies in corporate bonds, right? You have strong corporations like an Apple or a J&J that are never default. You got more medium risk bonds like, I don't know, let's pick a Best Buy or something like that. They might default if something crazy happens. And then you got really risky companies like, say, GameStop. GameStop doesn't have debt, but maybe an AMC. These guys are super risky. There's a decent chance they will default on their debt. So you'd rather buy, in a lot of cases, a senior corporate bond like Apple or Johnson & Johnson than buy sovereign country debt of a country like Pakistan, right? What's safer? Is Apple more likely to pay you back than the government of Pakistan? Probably, right? Even though it's a sovereign nation that has sworn on their army that they will pay back this money. I don't know. I'm trusting Apple. So the yield on Apple will probably be lower than the yield on Pakistan sovereign debt, or maybe even Swedish or Finnish sovereign debt, right? That might be a toss-up. Finland versus Apple might be a toss-up. Okay, so anyway, what does this have to do with equities? Well, it's the same concept. When you look at equity risk premium, you might think about it a few different ways, but one of the interesting ways people really like to think about it is dividend yield. There are some companies like Abbott and Johnson & Johnson that have paid dividends forever. and they have a dividend yield. Dividend yield fluctuates with the stock price, but their dividend yield could be as high as 2 to 3%. And if you look at it, what does that remind you of? Well, it reminds you of corporate bonds. But you're getting a 2 or 3%, but you still have default risk. If the things go poorly, they can slash that dividend, but they can't slash their obligation to pay you on the bond side. So a lot of people sort of conflate dividend yield and bond yield. And you can think about it as a carry trade, right? If you go long the Abbott stock and you go short the Abbott bonds, you would have to collect a net carry of 0, right? Because you have to pay interest when you short debt. You collect in the dividend when you are long the stock. So you give you a net nothing. But the prices of these two things will move too. The price of the bond won't move much. It'll probably stay the same, but you'll have the price of the stock, which will hopefully go up over the long term. So this is a great hedge, in my opinion. If the company goes bankrupt, this might not perform as well as this. So you might do the reverse trade as well, depending on how you feel about the company. That would be if, let's say, you were bearish or something. So it's important to think about stocks as kind of like cash flow generating machines to some extent, depending on the kind of business. You can't think of that for something like a Google. I think it's as stable as Google's business looks, it's still fairly young. But if you think about something like a Coca-Cola that way, I think that makes more sense. I don't know, I hope that's helpful. A lot of stocks shouldn't be looked at this way. And stocks that shouldn't be looked at this way probably deserve higher discount rates. That's why I always kind of do something like 6 to 8% or more for stocks. Like you notice for Google, I do 8%. And some people might say, it's too much. Google's a really great business. But I think that it's still relatively young. Let me keep doing this. I write these programs all day, all night. I was up till 2 a.m. last night writing programs for you, for your benefit. You don't even know it. You don't even know it yet. This is the thanks I get. This is the thanks I get. I'm on Swiss stocks, German stocks, Canadian stocks. I even looked. You want to see some of the stock markets I looked at? Can you guys see this? I'm not supposed to even be showing you this. I'm not supposed to even be showing you this. Can you see it? I'm looking at the Lisbon stock market for you. Do you even know where that is? Lithuania. How about this one? Ljubljana. Libya has a stock market? Lusaka? Never heard of these. Macedonian stock market, damn. Mauritius, I know that from the stupid game I played, the geography game. Albanian goats. I want you to be long Albanian goat stocks. Get those in your portfolio today. Montevideo, I don't even know what that is. Montenegro, yes, has a stock market. That's the country I'm from. You need real-time Zimbabwe stocks? How about Malawi? I'll give you Malawi. It's a very limited selection, I agree. Muscat securities market. I'm short kangaroos and I'm long goats, all right? That's the pair trade I need you to put on right now. Nairobi. See, the thing about being long goats and short kangas is you have a roughly equivalent sized animal. So across your portfolio, you want to neutralize that factor. You don't want to be all long short animals and all long big animals because you'll end up having a bad factor. Kangas Hop, easy play. One of my problems is I need a plug to the Australian Stock Exchange. This is actually a serious problem. I have this National Stock Exchange of Australia. That's not what I need. So the ASX is the major stock exchange there. I never lived in Montenegro. I'm from there, but I mean, my parents didn't like it enough. They moved here, so. But yeah, the funniest stock exchange I think was it Rwanda? I don't know. They're like, I definitely want to find like the shittiest, crappiest, tiniest stock exchange in the world and just go dominate. Just go in there like a pit trader. I think I looked up the Rwandan one has like 8 stocks, I think. Let me see if I can find it. Just want to go in there like you're walking into a casino. Nigeria, I wouldn't sleep on. Nigeria is a real stock exchange, actually. You'd be surprised. They're the real deal in Africa. But like Namibia. Let's go look at the Namibian stock exchange. Want to go in there, deposit 100 mil. Oh, wow. Market cap of 145 billion? No way. They got them diamond companies, I guess. They'll look at me, 100 mil, they'll look at me and say, yeah, this guy's a piker. Okay, they've got like, this is bigger than the other, exchange. This is like 20, 30 stocks. And have you ever heard of any of these companies? Swinging around Anglo-American. Okay, Anglo-American's a real company. That's a big company. It's all mining companies. Whipping that Namibia Breweries Limited stock. Established in 1920, old business. Okay, here's their NBS, it's called, Namibia Breweries. Market cap is 9.5 billion Rs. What is the R? Namibian currency. That's a NAD. So the R is the ZAR, maybe? The Rand? I think is that the South African Rand, maybe? Rand USD. 17, 18 Rand to $1. Okay, so that's like a $500 million market cap. That's not bad. Namibia Breweries. Discount rate for goats, I would say, is very low. Goats are very dependable. Give you meat, they give you cheese, milk. Goats they're very durable. They can carry shit even. Goats are the real deal. Discount rate's low. I don't know much about farming though, I gotta admit. Goats, very robust. Nairobi Stock Exchange. Malawi. Come on, Malawi Stock Exchange has to be pitiful. No offense to anyone from Malawi, but... Oh, it's lit! It's lit. Look at this guy. He's chilling. This is Steve Cohen of Malawi. They got a couple folding chairs, little podium. Okay, they got like 6 to 8 stocks. This one traded 100,000 shares. This one traded 862 shares. The big one is FDHB. That's FDH Bank. Market capitalization is 227 MKs, so it's a Malawi currency, USD. This is the Malawian kwacha. and it's 1,000 kwacha to $1, so $200 million bank. So that's their biggest stock. So yeah, we got to go to the Malawi Stock Exchange, just sit down. What a great meme, and do like those old brokers that use the hand signals. They're like, Mr. Shkreli, you just bought our Malawian bank. I meant to do the no, damn it.
The most important fundamental aspects of the hand signals, it's basically two parts. Number one is if your palms are facing in, that means you're a buyer. If your palms are facing out, you're a seller.
Goats, cats.
The distance between your arm and your face, that indicates two different things as well. If your hand is out, you're indicating the price you want. In this case, a price of 2. Whereas if you put the hand up against your face on the lower part of your chin, that's a quantity. A call option is indicated as a C. A put option is indicated like that, basically an upside down P. Some of the firms that are still with us, for instance, Goldman Sachs, you just touch the equivalent of where your ring finger is. Merrill Lynch, it's pretty simple. Their logo is a bull, so you just putting up bull horns. A lot of people have been expecting the death of the trading floor for quite a while. We're talking decades. So far, the lights have went out on every trading floor except for 3 in the United States for futures trading. That's the Kansas City Board of Trade, the New York Mercantile Exchange, and the CME Group in Chicago. Everybody knew and is fully aware that it's a dying art. In part, that's why I feel strongly about historically recording some of it before more and more gets lost to history.
Cool, huh? That's where I get my old nickname, Pit Boss. I show up in the pit, mosh pit, trading pit, doesn't matter. I'm ready for action. Throwing up gang signs in the trading pit. Now that means Merrill Lynch, but this means East Side Crips. It's a big difference. All right, we're doing an in-place sort. In-place functions scare me a little bit. We're not using master. We shouldn't use the term master anyway. It's has bad connotations. All right, so we just do an in-place sort. Then we're going to write the sort on That would be a funny skit, JW. The Tesla Crips. Back in my day, JavaScript stayed on the client side. That's where it belongs, to be frank. So Switzerland's most liquid stock is Nestle. I refuse to believe that this is the second one. The Japanese socially responsible UCITS doesn't sound right to me. Roche, that makes more sense. Novartis, that makes sense. It's weird. The API I get kind of like doubles the stock. I don't know if there's a specific reason it does that. I have to really dive into that. I mean, I'm just calling the API for like a list of securities, and it gives me kind of like double. Maybe that's how they charge, that's how they can inflate their charges. let's give them double. Charge them for both. A millionth of a penny per API call, so. Zurich Insurance Group. The Swiss are pretty anti-Semitic. Most of Europe is anti-Semitic, to be honest. Oh my God, I was in this clubhouse last night, and the clubhouse was titled something to the effect of, I saw it pop on my screen, and so I jumped in. So I saw this on my Clubhouse, and I jumped in the chat. It was basically like, you're all afraid to admit Kanye was right, or something like that. And I was like, oh, this sounds spicy. And I jumped in, and I said, okay, this is spicy. You know, I wonder if these are like some weird anti-Semites or whatever. So I jump in there, and these people are talking about organized religion and how the Vatican controls everything. And I'm listening to this crazy lady talking about the Knights Templar and the Opus Dei. And there's only like 20 people in this chat, but you gotta love these crazy chats. And I go onto the audience, to the stage, and I unmute myself, and I said, I think they were pretty upset at what I said, but I couldn't hold myself back. I said, this bitch thinks the Da Vinci Code is real life. And I just started laughing. I just couldn't stop laughing. And they're really offended that I said bitch, but it wasn't meant to be misogynistic, or it's a term of respect. I couldn't stop laughing. She was like, I don't know, but the Knights Templar, they control, I'm like, bitch, you've been watching the Da Vinci Code way too much. There's a secret society of people who have descended from the bloodline of Jesus. They guard the secrets. This whole stock market is controlled by them as well. And man, the stock market's controlled by a Long Island plumber named Steve Cohen, and a Long Island mathematician who smokes too much named Jim Simons. Stop playing. I'm still a farmer, bro. Don't ever not call me the farmer, bro. Did somebody want me to look at a biopharma stock? I know somebody said TG Therapeutics. Yeah, a young hustler named Kenny from Chicago. He's not even the new kid on the block. Griffin been getting money. I mean, he's still kind of young buck. But it's the programmer's turn, man. Programmers are eating the stock market alive. Yeah, Ken Griffin got started young. Eraska, Cassava, Absalera. Everyone likes Absalera, or wants me to look at Absalera. WWE? ARWR is really cool. I should probably look at Arrowhead. Used to be Arrowware, if you remember. Green Griffin got started real young. Knights Templar, yeah. I gotta find that chick on Clubhouse and become best friends with her. I don't know if you guys know this movie Dinner for Schmucks. she could be my schmuck. I used to think that we were going to do dinner for schmucks, but the stock market version. So the concept of dinner for schmucks is you basically invite. It's a pretty funny movie. Steve Carell is the star of it, but Zach Galifianakis does a good job too. You basically you basically find the stupidest person you can and bring them to dinner, and they don't know the difference. It's a pretty mean thing to do.
All right, how do I look? Ready?
A little sweaty.
Post it? There's a better place, one floor up. Today's the day. I'm gonna get the promotion.
Does that mean this is my new office?
Not yet.
I host a dinner once a month.
We can do Saturday.
It's not really a girlfriend type thing. You invite idiots to dinner and make fun of them?
Okay, that is messed up.
I know.
So you told them you're not going?
Oh, yeah. No, absolutely.
Why can't you just suck it up, make fun of some idiots?
Sometimes you have to do the right thing.
Are you okay? Yeah! I saw this little guy in the street. I was trying to save him from my masterpieces.
Amazing.
In the words of John Lennon, you may say I'm a dreamer, but I'm not.
The only one.
The only one.
That's the lyric. You may say I'm a dreamer, but I'm not the only one.
I don't think so, Tim.
Are you doing that dinner?
I'm sorry. I'll tell him dinner's off. Oh, my God.
Let it go!
I feel like I'm in The Shining. Oh, my God, my back, my back, my back.
Is it your back? You are tight.
I got in a fight with my girlfriend. I'd appreciate it if you just left.
It's a funnier movie than the trailer.
Be careful around this guy. He can tell what you're thinking. I've studied the human mind. I've learned how to read it and ultimately control it. Oh, I can't move.
Oh, buried move. Just move.
I can't.
Yeah, you can.
I can't.
I release you.
Oh.
This is about to start. There's been a complication.
You invited him to that dinner to impress your boss.
He's a sweet guy, but he's a tornado of destruction. Are you sure you want to do this?
That's what friends do.
Jim, I'd like to introduce my friend Louis and his wife Diane.
Your wife?
For now.
Oh. Dinner is served. Mind control. I am very, very powerful. Best dinner ever.
Sometimes I think you think I'm an idiot.
Just stay in the chair.
Tim!
Yeah, so I was going to do the same thing with the stock market version. Have 10 hedge fund managers, and you have to pick the dumbest stock picker that you know. And, I would bring like an Australian, not an Australian, although that's not a bad start. I would bring an astrology expert. I think that chick Marin would be a good one.
I've had a really surprising, really awesome number of young clients, like under. I am a little bit later with getting this sign video out than I usually would. Responded really well to these videos, talking about the rulers of the houses and how to connect them to use your birth chart to predict your life. So I wanted to do a video that is also really helpful on how to figure out what streams of income are present.
She's
I am a little bit later with getting this sign video out than I usually would be, but
No, I need to know what stock to buy. Help me out. I need to get this money. Give me this star money. Darn it. Where's the investment advice? Astrocartography. She does crypto. She got heavy into crypto. So that would be my dinner for schmucks guest. She would sit next to Ken Griffin and be like, how much money have you allocated to astrocartography? everyone else would bring some kind of technical analysis person, but all right, I'm gonna get going in like half an hour, so I have time to look at maybe one stock. I think Arrowhead is a good one. It's a really impressive company, to be honest. There's a lot to unpack, though, so I'm not sure I'm gonna get that far in half an hour, but got about like 45 minutes maybe. I have to go back to work, actual work. Okay, this is weird. They should have a more recent 10K. Oh, there's 10K, got it. All right, so it's called Arrowhead Pharmaceuticals, ARWR. It's a really prominent biotech company, $106 a share. Let's use Godel to look at the stock price. I think I have it in my biopharma list here. The problem with these quote monitors is you sometimes don't know where it is in on your list, if you have too many stocks in your list. But sometimes you also get used to it. Like you know, okay, that's the spot that stock is in. I'm not used to this quote monitor yet. I just got out of jail. Right, so this is the way mRNA works, and RNA interference especially works in this case with the RISC system is really important and interesting. And I would encourage you to learn it if you don't know. Here's a link to the Arrowware the Arrowhead, I'm still calling it by its old name, the Arrowhead 10K. And I would, if I were you, I'd read 10Ks all day long if you want to be a good investor. That's what Warren Buffett does. Learn as many companies as you can. You know, that's my advice. This is the 10Q. Yes, I want to go back to the 10K. Okay. So they're trying to target these drugs a little more fine-tuned. But before we get into that, the stock price is $32. There's 100 million shares outstanding. So a share is a piece of a business. You have a 1/100 millionth share of this company if you buy $33, one share, right? If you buy 1,000 shares, it would cost you $32,800, but you would have a 1/100,000th share, right? Because there's 106 million shares, so you would have a 1/106,000th share. If you bought 1 million shares, it would cost you $32.8 million, and you would have a 1/106th share, a little less than 1% of the company for $33 million. So the total market cap or market value of the company is just the product of the two. You multiply the price by the number of shares and you get 3.5 billion. So it's a $3.5 billion company. That's kind of a mid-sized company. I would call that a mid-cap, I guess. It's even closer maybe to a small cap. $3 billion company is not a small company, but it's not a huge company either. So it's kind of like mid-sized. So a drug company is, I really like the drug industry because it's basically a sum of the parts. You can actually add up each drug, and that's really all there is to the value of the company. Sometimes there's some value for a company's technology, but most technologies in the drug industry aren't that valuable as quote-unquote platform values or something like that. So we're just going to write down kind of some of the basic details of each drug. And again, this modularity that exists in the pharma industry is fairly unique. There are other industries that have something similar, but I really like the fact that, you know, each drug is kind of its own asset and you can value them individually. All right, so they have this pipeline chart. It's a little hard to read, so I'm going to blow it up a little bit. There it is. All right. I think my face is too big, right? Let me get that lower for you. All right, so we got their most advanced drug, which is ARO-APOC3. And this is a cardiovascular disease drug. And I'm not sure it's that great of a drug. Then they have ANG3. Then they've got this drug, olpasiran. Okay, so that's their 3 cardiovascular disease drugs. Dyslipidemia, which is a really competitive market. It looks like they have a deal with Amgen on one of them. Now they have a cystic fibrosis drug. That's a really bad target. Most people have given up on ENaC2. So that is basically a 0. RAGE sounds interesting. MUC5AC probably is nothing. And MMP7 is probably nothing. And if you become an expert in different targets, which each drug has a target, it's got some kind of place that it's pointed to. It's a protein of some kind. You can kind of tell what markets for diseases as well as what targets are interesting or worthwhile. So I'm seeing a lot of less than worthwhile targets here. And that's one of the problems with platform companies, is everyone's chasing the same target, whether it's RNA or antibodies. You sort of have this issue of, okay, well, we all have this technology, we're all going to point it at the same targets, and the trick is who gets the best targets, but everybody kind of knows about the same targets, but you know, there are companies that outperform others. So this is sort of their setup. I'm curious about the HBV drug, that's hepatitis B. The gout drug is worthless. I'm curious about the complement drug. I'm guessing it's C3, complement. Sort of curious about the NASH drug, but not really. Probably, I mean, I really like FSHD as a disease, but it probably won't work. RNA is a tough target for that. Any muscular disease. Don't tell that to this other company, though. AATD is probably pretty exciting, but there are CRISPR endeavors for that disease. All right, so we have some sense of their pipeline just as a quick glance. To me, it's nothing here that's too exciting, but let's read more carefully and not try to have any preconceived notions. All right, so they say that the first drug is ARO-APOC3. So this is a drug that stops APOC3. You know, we can make a sheet just to make some notes. This is apolipoprotein C3. It's a component of VLDL, chylomicrons, which, you know, this is important in hypercholesterolemia, but there are a lot of drugs that can help you there. Although triglyceridemia is maybe sometimes a little harder to treat. The thing about triglyceridemia is it's not that serious of an illness unless you have this FCS, which is this really severe form, familial hypertriglyceridemia. And even if you have triglyceridemia, there's a lot of issues with whether or not lowering it will actually make a difference. Because there were companies in the past that have tried to market hypertriglyceridemia drugs, and you might hear from a doctor, oh, your triglycerides are high. I have tri spelled wrong here, T-R-I. So yeah, FCS patients have really high triglycerides, but I thought there was other FCS drugs. I thought Ionis had one. So they have, let's see, this is a phase 2B trial called the Shasta-2 trial. Interesting name. Sounds like a rap album or something. Severe hypertriglyceridemia. So the question is, like, will the FDA approve you for hypertriglyceridemia? like here's another phase 2b study, but let's go to phase 3. This is FCS study. That is an approvable disease. These people have such high triglycerides, like they really need help. And they're calling that the Palisade study. Okay, so we'll kind of look at the hypertriglyceridemia market, but it's very, very small market, you know, not exciting. Not enough probably to value a company at $3.5 billion. So probably the more exciting drug people are interested in is ANG3. So this is called ANG3. And this is for dyslipidemia. Now that is a disease that has a stronger tie to having high lipids results in cardiovascular events. When I say events, that's a nice word for heart attack, stroke, and death. So lowering lipids is something the FDA and doctors more accept is directly tied than, say, triglycerides, which is more loosely tied. At least that's what the clinical evidence has been. I'm not saying you should go get high triglycerides. So ANGPTL3 is angiopoietin-like protein 3. It inhibits LPL. If you inhibit it, you'll lower LDL. If you look at the some of these drugs, like in this market for like extra lipid reduction, haven't done that well. This market's fairly saturated, no pun intended. Here's a phase 2b study called ARCHES 2. And then here's another study in HoFH, which is this bizarre genetic hypercholesterolemia. Gateway study. Okay, so we'll break down kind of the market for other dyslipidemia agents, and that's kind of like the reason that sometimes we look at these big pharma stocks and people wonder, well, why are you spending so much time with Pfizer or Merck? Because those stocks aren't going to do very much. And that's true. Their stocks themselves probably won't do a lot, although I've made a lot of money in those stocks over the years. You just have to trade them a little differently than you would trade a company like Arrowhead. But even more importantly, you kind of get a feeling for what the industry's interested in, what the industry's heading towards. Because at the end of the day, like these small biotech companies, even a bigger one like Arrowhead, at the end of the day, they're all kind of dog poopy companies. I'm trying to be more PG-13, by the way, on these streams. They're kind of little small companies that are not going to last forever. So, you know, you can't take them too seriously. They're not like an Eli Lilly or a Merck that'll be around a while. Oftentimes their goal is to be acquired, that's right. All right, so ENaC is not even worth discussing, I think. There have been ENaC drugs and they've failed. So I think very few people take ENaC too seriously. RAGE is maybe a little more exciting. So they're doing an asthma study, that's kind of neat. There's a lot of room for new asthma drugs. You know, it's just a space that's kind of been ignored. There are more people interested in it these days, but still it's like very underserved in my opinion, even with new drugs like Dupixent or the AstraZeneca drug. I actually took a dose of it on live stream. I don't know if you guys saw that. Eucala. So that could be pretty interesting. I don't necessarily see the correlation between RAGE and asthma, but so my guess is that trial will fail, but the possibility that it works would be a game changer, obviously. Yeah, you saw the auto-injector. It helped a little bit, but I really want to try Dupixent, so I'll do a Dupixent shot reveal soon. Julia, somebody wants to program Julia? All right, MMP7 for IPF. IPF is a big market. MMP7 is unlikely to be that successful, but what's cool about these guys is that they're doing inhalation of RNA. I think nobody else has really done that. So, you know, there's something to be said for that. That's kind of neat. And here's maybe the most interesting drug, which is their complement 3 inhibitor. Again, kind of a competitive market, but something that's a well-known kind of rare disease market that has a lot of revenue affiliated with it. So GSK licensed HSD. But I thought, okay, I see it now. Horizon licensed the gout drug. XDH isn't too exciting. I guess it's Amgen's now. Takeda licensed the AATD drug. This has now got a name called fazirsiran. Fazirsiran. This is probably their lead drug, I guess, is my guess. But they have a deal with Takeda, which makes it a little, it's always a little confusing. So it's called TAC999, that's Takeda's code, or AROAAT. The generic name is, like I said, fazirsiran, and it's for this liver disease, genetic liver disease, very interesting illness called alpha-1 antitrypsin deficiency. It's also called AATD. It damages liver and lungs. So if you silence the gene, you probably end the disease. This is also something that we mentioned Intellia is working on as liver CRISPR, so there will be competitors to Intellia. Kind of reminds me almost exactly of what's going on in the other market that Intellia is in. Let's take a look real quick. The ATTR market and the AATD market. So they have an AATD CRISPR coming real soon. In fact, this year, the first people will be dosed with that. And their ATTR curative therapy, basically, is also happening. So one has to wonder if the Intellia IND in second half 23 would overshadow this. Although, again, as we talked about it with Intellia, like, it's not really clear that, you know, CRISPR is the end-all be-all of, and the end of days for antisense and other nucleic acid therapies. They could compete effectively, I think. If I were the patient, I'd rather get the one-shot cure, but... Okay, so this is pretty interesting. This is the hepatitis B treatment. 3989. You can see that J&J has invested a lot in developing this drug. I wonder if they'll advance it to phase 3. It's really interesting. J&J generally doesn't develop a drug unless it can be multi-billion. That's at least been my experience with Johnson & Johnson. Other drug companies that's not often the case. You know, they're really focused on those multi-billion-dollar drugs. Even $1 billion for J&J is like not that exciting. I'm 5'9", but I don't have any sensitivity about my height. If I was 5'2", I'd be just as happy. Some people are so scared and nervous about their height. They wear stilts, basically, or heels for men. Sad. You have to be confident who you are. You know, I've been a shrimpy, skinny kid my whole life. I'm okay with that. Okay, so here's olpasiran. This is LPA. For some reason, this drug is like deprioritized. Although it says that they are doing a phase 3. So I don't know what. It's probably not deprioritized, but they don't talk about it. We're looking at Arrowhead. I don't know what position we're gonna advocate for, but you got mugged going to school at in Brooklyn? I went to high school in Manhattan, but I've got into two or three altercations in terms of like mugging. The big one I had was just a straight up brawl. It was a fight. It was me and 3 kids. 2 were a little younger than me, 1 was older than me. And that was on the 1 train in Harlem. It wasn't a big deal, but it was definitely an experience. The other 2 were like more like soft attempted muggings, and I'm the kind of guy that, you know, just refuse to be bullied and refuse to be, you know, pushed around. I'd always have my Walkman or Discman. Back in the day, we had Discman, not MP3 players. So it was a CD player, and you'd have to carry the CDs with you. And I would always have my CD player on, and I'd have the music on really loud, and I'd like kind of walk pretty aggressively. So like, I'm not your like best target for a mugging. Like, even though I was very skinny, I had a bit of just an attitude that was, you know, fairly, you know, you pick an easier target when you're looking to rob somebody or something like that. Yeah, 110 pounds. And it depends on, like, if you wear glasses, it depends on your posture, things like that. But I didn't have too many problems in Brooklyn. Sometimes guys would try to start things in Brooklyn when I'd play basketball. I played a lot of basketball, but, you know, you also have to have the right attitude. I mean, Brooklyn and Bronx and Manhattan and Harlem were more dangerous a long time ago. I guess the rumor is they're starting to get more dangerous again. But so of course, needless to say, Arrowhead has no product on the market, so it's just a company with a ton of costs. And here's the cash flow. I guess their fiscal year ends in September, joy of joys. You could see just 100 million out the door, 100 million out the door. This year they got 170 million in the door. I think that was probably from licensing their products. So they did a deal with Royalty Pharma, who I consider to be pretty smart money. So Royalty Pharma has a stake, in essence, in... Oh, that's probably why it's deprioritized. It looks like they basically bought the stake of olpasiran. So they probably don't have too much economics left. That's crazy. Al Valankar. I know you're a real one from Brooklyn. I used to go to Marine Park all the time, play basketball. The competition in Marine Park was never any good. And the rims were a little shorter than normal, so it was easy to grab the rim. It's like a 9.5-foot rim. Oops. It's easy to short South Korea. You could do it with futures, you could short their stocks, like Samsung. That's an interesting way to look at it, short the index based on the fertility rate. But the problem is a lot of those companies aren't geared on fertility, they're geared on exports. For example, most of South Korea's is Samsung. It's all exports, so I'm not sure it matters that their country has a declining fertility rate, as long as their companies don't have declining fertility. Their companies' customers, I guess. All right, so they don't have any debt from what I can see. So it's about a $3 billion enterprise value. It's a really hard to parse company. It's a lot like Ionis, but to me, the targets are less exciting relative to Ionis. It sounds like AAT drug and the Hep B drug are most of the value. So we have to do a pretty deep dive into those. As I mentioned, for AATD, a lot of nucleic acid, gene therapy, and CRISPR companies are targeting AATD as kind of a fairly low-hanging fruit. And they've given up some of those economics already to Takeda, which for a disease that's pretty easy to sell yourself, I'm not sure that that was the best decision. It sounds like they sold all the royalties of olpasiran already. The FCS drug won't be very high selling. The ANG3 drug, I'm not sure is that exciting. We know ENAX is 0, RAGE is too speculative, Mucin is probably too speculative, as well as IPF. NASH is kind of a boondoggle regardless. Gout is a 0. So you've got PNH. All right, so would you pay $3 billion for partial rights to 2 drugs and whole rights to 1 complement drug? That's fairly competitive as well. I don't know, it kind of seems like a short. Let's look at the let's look at their press releases and kind of see what they've been focusing on. Okay, well, they have results for fazirasiran. Oh, wow. 94% reduction in ZAAT accumulation. Damn. All right. Still need to clear the lungs, right? But that's pretty good results. The plot has thickened. I withdraw the comments about there being a short. I have to look at AATD liver sequelae. Is it really that severe? But if I'm a patient, I definitely want this. I wonder if the FDA says, all right, well, is this really a meaningful endpoint, AAT reduction? Do you need to show fibrosis or some other harder endpoint? Because AAT is not, I understand ZAAT is the causative agent of the illness etiologically, but the FDA likes to see symptom improvement as a primary endpoint, or transplant or something really hard like that, which is unlikely to occur here. So I don't know what the phase 3 endpoint, here it is. 160 patients, that's it? Wow. And here's the primary endpoint, would be a decrease from baseline of at least one stage of the histologic fibrosis staging through biopsy at week 106. That's a 2-year study. Yeesh. So that's the problem, is you have to translate that surrogate marker into a clinical outcome, which can be difficult, needless to say. But this is still pretty exciting. Could that be a billion-dollar drug? It doesn't seem like it. Maybe? We have to look at the economics as well. But it's kind of weird, like, to take a drug that only fixes half the illness. Like, the lungs are relevant as well. %, reduction, that's amazing. 16 patients, a pretty small group there. Metavir stage. There was a placebo. They had a 26% increase in liver ZAAT in placebo. Okay, they did serum reduction was significant, so that probably helps the lung too. Okay, so this is a 50-50 US profit split with 20 to 25% royalties. They paid $300 up front. Nice. You could sell 300 or 400 million fairly easily if it gets approved, but I don't know if it'll hit this endpoint. 2-year endpoint, pretty good, but it's a gamble. It's definitely a gamble. If this is their only drug, it's sort of fairly valued, but you do get these other drugs kind of for free. Although I'm not sure they're worth much. It certainly doesn't look like a screaming long. Very interesting, though. I appreciate the question to look at the stock. I definitely have been slacking on looking at biotech. I've been really busy programming. I program every day. I was up last night till 2 a.m. writing some stuff about Chinese and Canadian stocks, German stocks as well. Trying to find a good Australian stock API. All right, I'm going to upload my stock models, so if you want to check those out, you can head over to my GitHub. Added a bunch of patents as well. PDFs and things like that. So most people don't use GitHub as a file storage tool because it's really meant for version control, but you can use it for file storage too. Hansa, I haven't looked at Hansa in a little while. The FDA doesn't really worry about the generic market in terms of capitalism or anything like that. I mean, they just approve generics when and if they prove that they're similar, as they should. I don't know what ChatGPT should focus on. That's up to them. I wish them the best. I don't think they have a scaling problem, to be frank. I think they should focus on the product. I don't think the Saba drug works, but I have to look at it more closely. I have to look at Takeda more closely. I don't follow the AI sector, the publicly traded sector, too carefully. I've never had a problem with the OpenAI server. If you're an API customer, if you're a free customer, then that's your problem. My edge in investing is looking at lots of companies and having a deep knowledge of my sector. Any last questions before I run? All right, everyone. Thanks so much. Talk to y'all soon.